Hello dear CA Inter students. In this video, we are going to very quickly discuss the accounting treatment of dividend. I hope you have already studied consolidation chapter. This is just discussing about the dividend adjustment, and only those who have studied will understand the treatments because this is for revision purpose only. So listen. So what if holding company, first I am taking holding company, already declared and accounted dividend. If already declared and accounted, if you can visualize the balance sheet of holding company's balance sheet already has a dividend payable. Holding company's balance sheet already has a dividend payable. So what is to be done? Nothing to be done. Just take to consolidated balance sheet because there is no mutual owing concept there. Holding company's dividend is payable to outside shareholders. So there is no concept of mutual owings. Just take it to consolidated balance sheet. That's it. Now, what if it is given as an adjustment? In the adjustments when I am reading, holding company declared a dividend of 100 rupees in the current year but not accounted. Then deduct it from holding company's P&L. That consolidation of reserves adjustment we do. We take holding company's profits, add a share from subsidiary, less dividend declared by holding company, deduct 100. Before going to balance sheet, holding company's P&L should be deducted by 100 and present dividend payable in the balance sheet. Same. So take to consolidated balance sheet. Similarly, present dividend payable in the balance sheet. Then, I hope it is okay. If there is a doubt, just comment below. I'll clarify it. Now, what is the accounting in the books of subsidiary company? See, subsidiary company's dividend is the hot topic here. Subsidiary company's dividend. What if subsidiary company has paid a pre-acquisition dividend in the question? So, this very common adjustment. Let me brush up. A Limited acquired 80% shares of B Limited. A Limited acquired 80% shares of B Limited on 1st April 2025 and on 1st July 25 after the date of acquisition, B Limited is paying dividend for the previous year. So, holding company, subsidiary company relationship came into picture only on 1st April 2025. 1st July, subsidiary paid dividend for the previous year. So, naturally on 1st July, say if 100 rupees is the dividend, 80 rupees will be received by A Limited. If 100 rupees is the dividend declared by B, 80 will be received by A Limited. So what is the accounting treatment while preparing CFS? Point number 1. Deduct 100 rupees. Of course, subsidiary paid, holding company received. So two aspects. Subsidiary paid. So deduct 100 rupees from subsidiaries paid out of previous year profits only. Because previous year dividend is paid out of previous year profits. So deduct 100 rupees from subsidiaries pre-acquisition profits. Okay, when I am doing analysis, I am taking subsidiaries pre or opening profits, deduct 100. Okay, done. Now, holding company received. Holding company received a pre-acquisition dividend as per AS 13. Pre-acquisition dividend received 80 should be credited to investment. Bank to investment. Bank to investment. Bank to investment is the journal entry. This is the correct entry. If holding company has passed the correct entry, super. No more adjustment. Holding company, sometimes in the question they will say they have wrongly credited to P&L. Then what you should do? Rectification entry. What is the rectification entry? P&L to investment. So, holding company's profits should be reduced. P&L is to be debited because it is already credited, right? Wrong ആണ്. P&L add ചെയ്തു. തെറ്റാണ്. So, deduct, P&L deduct, and correctly account it, credit it in investment account. So investment account should be reduced. When you calculate goodwill capital reserve, investment account reduce here. Investment, cost of investment less pre-acquisition dividend. Now, what if current year dividend? Subsidiary company declared 100 rupees dividend for the current year, for 2025-26. Here in the case, dividend was declared for the previous year. But what if dividend is declared for the current year, 25-26? Then what is the treatment? Already declared and accounted, means already passed the journal entry P&L to dividend payable. They already passed the journal entry P&L to dividend payable. Already passed the journal entry P&L to dividend payable. Then no need to deduct from profits because it's already accounted. Post acquisition, current year dividend means post acquisition dividend, already deducted, already accounted. Then no need to deduct again from subsidiaries profits. Then subsidiaries point of view, it is already accounted. But if holding company's point of view, if it is not accounted, account receivable 80. What is the entry? What is the entry? Dividend receivable to P&L. Dividend receivable to P&L. Why dividend receivable to P&L? Post acquisition dividend, credit to P&L. Holding company's profits, add a share from subsidiary, add a share of dividend receivable. So holding company's books, there is a dividend receivable, and subsidiary company's books, there is a dividend payable 100. Holding company's books 80 dividend receivable. So now cancel it as mutual owings. So in consolidated balance sheet, what is payable to minority interest? Only 20 will appear. So can you explain once more? Dividend already accounted for the current year. Subsidiary company's balance sheet, there is a dividend payable. Subsidiary company's balance sheet, there is a dividend payable. Holding company should account its share because it is post acquisition dividend. So add to holding company's profits. Then there is a dividend payable in the books of subsidiary. There is a dividend receivable in the books of holding. Now it will be mutually cancelled. Payable, receivable to the extent of 80% will be mutually cancelled. And only 20 will appear in the balance sheet as payable to minority interest. Dividend payable, only 20 will appear. Okay. Now, the same thing only, but subsidiary declared, same thing only, subsidiary declared dividend but not accounted. Subsidiary declared but not accounted. Subsidiary declared but not accounted. Then what is the correct entry? P&L to dividend payable. When you do the analysis of reserves from the post acquisition profits, you deduct dividend payable. So subsidiaries books you account from the post acquisition profits, P&L to dividend payable. So it is not accounted, you should account P&L to dividend payable in our step 3 analysis from the post acquisition profits. Post acquisition profits you deduct. Holding company, it is the same, account dividend receivable 80 to P&L. Cancel mutual owings, only 20 will appear in the consolidated balance sheet. So if it is not accounted, I'll account. If it is already accounted, no need to adjust because it is already accounted. Are you understanding? If there is a doubt, just comment below, I'll clarify it. Then, what if the next possibility is, what if the third one or the last one, shares acquired during the year, which means if I acquire shares on 30th September and a part of dividend becomes pre-acquisition. I didn't understand. See, A Limited acquired shares in B Limited, same example, but we acquired only on 30th September. Then what is to be done? Then current year was 6 months becomes what nature? Pre-acquisition nature. And last 6 months is only post-acquisition nature. But this company declared a dividend of 100 rupees. And 80% is my share. Then what is the accounting? Then what is to be done? So here in the books of subsidiary, or from subsidiary's point of view, from subsidiary deduct 100 from current year profits. So if you have a doubt, let's take an example. Like subsidiary's closing P&L is 1000. Subsidiary's closing P&L on 31st March 26, 25, 26, 31st March 26. Subsidiary's closing P&L is 1000. And subsidiary's opening P&L, say on 1st April 2025 is 200. Just randomly 200. Now I'll do like this. Subsidiaries 1000 rupees profits. First 200 is anyway what nature? Pre-acquisition nature. During that year total profits earned is 800. And there is a dividend declared which is not accounted. So I'll deduct 100. 700 is the balance 12 months profits. This I will divide it as pre. First 6 months 350 and balance 350 is only post. So I deducted that 100. I am passing the entry P&L to dividend payable. Did you understand? Now from holding company's point of view, holding company should account 40 rupees as dividend receivable. Dividend receivable 80%. Dividend receivable 80%. To how much only I should recognize as to P&L? Post acquisition profits 40. And balance pre-acquisition nature should be credited to investment. This is parent company's accounting. This is subsidiaries P&L should be debit. Sorry. So this is parents, this is subsidiary, parent and subsidiaries. Now if it is just declared there is a dividend payable and dividend receivable, so 80 I will cancel mutually and only 20 will appear in the consolidated balance sheet. So it's only, see, if it is just declared, payable and receivable anyway should be mutually cancelled. If fully dividend declared is fully out of post, credit it to P&L. But if it is out of pre-acquisition profits, then it should be credited to investment. So subsidiaries point of view, always debit P&L. Holding company's point of view, credit P&L if post or credit investment if it is pre. So I can summarize like that. I hope it is clear, and if there is a doubt, just comment below and try out the questions with this dividend adjustment, and in all the questions we have done the same thing. Okay, so if there is a doubt, comment below. I hope it is clear. Happy learning. Take care.